The second paycheck had already been direct deposited for years before anyone noticed how permanent it had become. By the time the promotion came through, the household budget had stopped wobbling. The mortgage cleared on the first of every month without tension. The daycare withdrawal processed automatically. The two car payments moved out within 48 hours of each other. Retirement contributions increased quietly through payroll adjustments no one talked about at dinner. It all looked stable from the outside. It felt responsible. The second income had not begun as a necessity. It began as insulation. Student loans were still active then. Health insurance premiums had just risen. The housing market in their metro area had climbed faster than expected, and locking in the house required stretching further than either of them had originally imagined. Two incomes made the stretch reasonable. Not aggressive, not risky, just prudent. Years passed before anyone described the arrangement as permanent. At first, both careers were growing. Raises arrived in uneven increments, but they arrived. Employer matches compounded. The family health plan became the default choice because it covered more. When the first child was born, parental leave staggered rather than overlapped. The lost wages were absorbed. When the second child arrived, the daycare bill doubled, but so had household earnings since the purchase of the home. The math held. In those early years, the dual income structure felt like upward mobility in motion. They refinanced once when rates fell, reducing the monthly payments slightly while extending the timeline. It freed up cash flow that went toward 529 contributions and a newer SUV with more space. The logic was layered and calm. Both carriers were stable. Both employers offered benefits. Both health insurance options were employer sponsored. The risk of disruption felt distant. The calendar filled gradually. School events required coordination. Vacation days were divided carefully to manage pediatric appointments and seasonal illnesses. The flexibility once assumed in each job narrowed as responsibilities increased. Promotions brought higher salaries, but also fixed expectations. Deadlines hardened. Travel increased. Performance reviews mattered more because compensation growth was no longer supplemental. It supported the structure. By their early 40s, the household income had reached a level that placed them comfortably within their regional middle to upper middle range. Friends described them as secure. Neighbors saw two professional adults leaving early and returning after dark. The house was maintained, the lawn trimmed, the cars reliable. On paper, the numbers were solid. The strain did not appear in the ledger. It appeared in the margin. When one employer restructured during an economic slowdown, it was described internally as a strategic realignment. Roles were consolidated, departments combined. The severance package was reasonable, but the paycheck stopped. The health insurance was tied to that job. Cobra premiums were higher than expected. The mortgage payment did not change. The daycare withdrawal did not change. The car payments did not change. Property taxes continued to rise incrementally, as they had every year. The second income, once insulation, had become structural load bearing. The household savings account covered 6 months of expenses on paper. But 6 months assumed immediate reemployment at comparable salary. It assumed health coverage gaps would be short. It assumed the job market would cooperate with professional history and prior compensation levels. The calculations became tighter when written out. During the unemployment stretch, the remaining salary carried everything. It was enough, but barely enough. Retirement contributions were paused. College savings contributions were reduced. The emergency fund began declining in visible increments. The shift was subtle but measurable. The entire structure had been calibrated for two steady streams. One stream, even at a high income level, altered the geometry. Re-employment eventually came, though not at the same base salary. The new role offered flexibility, but fewer long-term growth incentives. The health insurance deductible was higher. The employer match was smaller. On paper, they were still a dual income household. In practice, the second paycheck no longer had the same trajectory. Nothing collapsed. No crisis forced a sale of the home. But the realization formed gradually. The life they had built was engineered around two consistent earnings, not one strong earner with optional support. This distinction reshaped everyday perception. Earlier in their marriage, either spouse could have imagined stepping away temporarily, one to pursue graduate education, another to pivot careers, one to scale back hours while children were young. The financial model seemed flexible enough. But once the mortgage balance remained substantial, once property taxes rose in tandem with home values, once healthcare costs escalated annually, the margin narrowed. Scaling back meant visible trade offs in savings rates, insurance coverage tiers, and educational funding. Dual income had shifted from opportunity to obligation without announcement. There were evenings when both laptops were open at the kitchen table after the children had gone to bed. Work extended past dinner. Not dramatically, just steadily. Each job required maintenance. Each performance review cycle carried weight because each salary supported a fixed structure designed years earlier. The house itself embodied that commitment. Purchased during a competitive market, it had appreciated. Equity existed. But selling would mean re-entering a housing market with higher rates and higher prices. Downsizing would require school district compromises. The mortgage, once a milestone, had become an anchor point around which two careers revolved. Health insurance premiums increased every January. The percentage change looked modest in isolation, but compounded across a family plan, it altered monthly cash flow. Deductibles rose. Out-of-pocket maximums crept upward. Flexible spending accounts were adjusted accordingly. These changes were absorbed, not debated. There was no dramatic conversation about affordability, just recalibration. Their tax bracket climbed incrementally as salaries increased over time. Federal withholding adjusted automatically. State income tax obligations grew. Contributions to retirement accounts reduced taxable income, but only to a degree. The take-home pay always felt slightly less expensive than the gross income suggested. Dual earnings amplified this effect. Two incomes meant higher marginal exposure. The system functioned as designed. By their mid-40s, both had reached career plateaus common in professional tracks. Raises slowed. Titles stabilized. The compensation curve flattened while expenses continued their predictable upward path. Teenage grocery bills, higher auto insurance premiums for young drivers, extracurricular fees, modest home maintenance projects that could no longer be deferred. The structural strain did not manifest as debt accumulation. It manifested as dependence on continuity. Every employer change carried implications beyond professional growth. It affected healthcare networks, retirement plan vesting schedules, commuter distance, and scheduling flexibility. Decisions once evaluated on interest or ambition were evaluated on benefit stability. Dual income required synchronized reliability. The margin for one career to experiment narrowed as the other stabilized. There was a period when one spouse considered moving to part-time work. The calculation was not emotional, it was mathematical. Reducing income by 30% would reduce net household earnings by more than that after taxes and lost benefits. It would slow retirement accumulation meaningfully. It would require rethinking college funding timelines. The option remained technically available, but practically complex. The household never described itself as overextended. They met obligations. They maintained positive net worth. Their credit remained excellent. But the awareness settled in quietly. The lifestyle calibrated around two incomes did not easily flex back to one without visible contraction. The early assumption had been that dual income created freedom. In reality, it had created a larger fixed baseline. Friends in similar demographic bands shared comparable patterns. Two professional salaries purchased homes in high performing school districts. Two salaries justified larger mortgages. Two salaries supported childcare costs that enabled both careers to continue. It was internally consistent. The structure sustained itself. Yet it required ongoing participation from both parties to remain balanced. As retirement planning discussions became more concrete, another layer emerged. Social security projections were based on individual earnings histories. Pension eligibility differed. Employer sponsored retirement accounts varied in fees and match rates. Coordinating contribution levels required attention because household retirement security depended on sustained dual participation across decades. The strain was not emotional burnout, it was structural interdependence. When aging parents required assistance, flexibility again became constrained. Time away from work meant unpaid leave or accumulated vacation depletion. One spouse could not fully absorb caregiving responsibilities without altering the financial equation. The assumption that dual income provided resilience felt less certain in the presence of simultaneous obligations on multiple fronts. Home maintenance costs surfaced more frequently as the property aged. Roof repairs, HVAC replacement, exterior painting, non-catastrophic, all expected. These expenses had been planned for abstractly, but in execution, they required liquidity. Liquidity depended on consistent payroll deposits. The realization did not arrive in a single conversation. It emerged over years of minor recalculations. At a certain point, the second income was no longer discussed as a contribution. It was assumed. The question shifted from, do we need both salaries, to, what would change if one stopped? The answers were not dramatic, but they were extensive. Savings rates would slow. Insurance tiers might adjust. The mortgage would feel heavier. Discretionary travel would contract. College contributions would decline. Retirement timelines might lengthen by several years. None of these outcomes were catastrophic. They were incremental. Dual income had functioned as acceleration during early adulthood. In midlife, it functioned as stabilization of commitments already made. The children eventually reached high school. Daycare expenses ended, replaced by different costs. One car payment concluded, only to be replaced by insurance premiums for a teenage driver. The budget reallocated rather than shrank. The structural baseline remained elevated because it had been constructed during years of dual earnings growth. Looking back, the decision for both to work full-time had always appeared responsible. It had enabled homeownership in a competitive region. It had funded retirement accounts aggressively in their 30s. It had reduced reliance on consumer debt. These were measurable benefits. But it had also shaped the scale of every fixed commitment. When conversations about early retirement surfaced among peers, the numbers required to exit the workforce entirely were tied to decades of living at a dual income level. The portfolio target reflected household expenses that had grown in parallel with earnings. Scaling down later required conscious contraction. There was no regret attached to the path, only recognition. The second paycheck had entered quietly years earlier and gradually fused with the first into a single financial identity. The household balance sheet did not distinguish between them. Obligations were calibrated to the sum. By their early 50s, both careers remained active. The mortgage balance had declined but not disappeared. Retirement accounts were substantial but not yet sufficient to replace two incomes comfortably. Healthcare costs remained employer tethered. The structure persisted. Even on calm evenings, when no bills were due and no crisis loomed, the underlying architecture was visible. Two alarm clocks set on weekdays, two sets of benefit enrollment forms reviewed annually, two streams of payroll taxes withheld, two performance evaluations scheduled every year. The life they built functioned. It provided stability. It delivered predictable outcomes consistent with their demographic band. It met obligations without drama. But it required continuation, and continuation, by midlife, had become its own form of commitment.